GIG Capital biến điều kỳ diệu thành sự thật.
As a result, in Europe, more and more leverage buyout have occurred over the past decade, and more significantly, they have grown in size, and as Range have been able to raise a bigger pool of capital to support large multi-traditional transactions to fuel this growth market. A broad range of bank from multi-region now fund this deal, along with the European institutional investor and the USA institutional investor, resulting in the creation of a loan market that cross Atlantic. European market has taken advantage many of this lesson from the USA market while they maintain its regional diversity. In Europe, of the regional diversity allow banks to maintain a significant lending influence and force the provider equity dominance in the market. Type of syndication. Syndication not only one type, there is many type. This is the theoretically speaking is the three type, but they can flexibility controlled by the lead manager is the mandate. Maybe the equity, private equity sponsor. You understand? They can do. Globally, they are three type of the underwriting for the syndicator. Underwritten deal, best effort syndicator, and a club deal. This European range, the syndicated loan market, most exclusive, consists of underwritten deal, whereas the USA market contains mostly the best effort. You understand? European market is the underwritten deal. USA market is the best effort deal, and also another is the club deal, different one. Club deal, they already have they have club. Understand the banking club, maybe investor club, maybe institutional investor club over there, and the club is they are very friendly, They cooperate each other, maybe each trench, that is the maybe the syndicate is very important club deal, and the trench is very make a pool and trench, and already they have a club and trench. You understand? Different. Underwritten deal is one for the which the arranger guarantee the entire commitment. In this case, a big bank and also maybe the underwriting bank. Then syndicate loan. If the arranger cannot fully subscribe the loan, they are not forced to observe a difference, which they may rather try to sell to investor. This is easy, of course, if market condition or the credit fundamental improve. If not, the arranger may be forced to sell at the discount and potential even take loss on the paper, or the arranger may be just left above the desired holder level of the credit. Arrange underwriter loan, several loan. The first offering underwritten loan can be competitive tool to win mandate. Second, underwritten loan is usually required more lucrative fee because the agent is on the hook if potential lender bulk. Of course, with the Pilex language now, common underwriting a deal does not carry some risk it once did when the pricing was set in stone prior to syndication. Second, the best effort syndication. Number one is underwritten deal. Best effort syndication is one for which the arranger group commitment to underwriter less than or equal to the entire amount of loan leaving the credit to the big institute of the market. If the loan is underscribed, the credit may not close or may need significant adjustment to its interest rate or credit rating to the cleared market. Traditionally, the best effort syndication were used for the risky borrower or for complex transaction. However, since the late 1990s, the rapid acceptance of marketplace language has made the best effort loan the rule even for the investment grade transaction. This is maybe a little flexibility to do that deal. You said is the made the best effort loan the rule even for the investment grade transaction. Club deal. Club deal is the smaller loan. Smaller loan usually the maybe 5 million to the 100 million. But as high as 150 million, that is the pre-marketed to group of the relationship lender. The range is the generally the first among Q equal, and each lender get full cut and nearly full cut of P. Full cut. The syndicate process. As a syndicated loan is the collection of the bilateral loan between the borrower and several banks. Several banks in here, not only one commercial bank. This bank is in here commercial bank and or investment bank, or another maybe a limited partnership too. The structure of the transaction is the isolate each bank interest whilst maximizing the collective efficiency of monitoring and enforcement of a single lender. The essence is to make loan one similar term to make a bundle of loan into the single agreement. You know, one agreement inside of the many party. You understand? Tranche, first tranche, second tranche, third tranche. This team is how much, this team is how much, this team how much of the loan amount, and how to the loan payback term, interest rate, and everything is different one. In this case, they say single contract. This drawn up loan market association document correspondingly 3 key actors operate within syndicate lending: arranger, agent, trustee. These actors utilize 2 core legal concepts to overcome of a difficult large cap lender. Understand? Those being agency and truster, a single bank may not on its own be willing or able to advance of the whole amount. The essence of syndication is that 2 or more banks agree to make loan to the borrower, to a borrower. You know, the lender is the several multi-lender, and one borrower, you understand, 2 lender. Uncommon term governed by the single agreement. This is the already told to you. Is a syndicate loan is the multi-loan lender and one borrower. You understand? One borrower, one contractor. This is arranged only, not only the regulator, the relationship between the lender and the borrower, but importantly between the lender. Most loan and the document using LMA is precedent in England. This will not be on lender written standard term of business for the purpose of UCTA 1977. the distinction in the lending agreement and the use of the three aforementioned actor is the preliminary to avoid of creation of a partnership, avoid the lender from the advertently acting as a guarantor to the another, or to prevent the set off. The borrower is the sometimes given a yanked bank power to force a transfer of lender interest in the payment as choose in action. If the lender does not consent to waiver or amendment, lenders are traditionally limited in their decision making by overlapping clause required voting and collective decision making. This act as a distinctive for the individual lender to act in their own interest over the collective group. It have been suggested that the historical cooperation within the London loan market help produce efficiency in solvency working out through the London approach. What is the meaning London approach? Historically, European banking handled non-investment grade lending and also capital structure that were fairly straightforward. A nickname of the London approach. In the UK, restructuring focus on the avoiding debt write-off rather than provide a distressed company with appropriated sized balance sheet. This approach became impractical in the 1990s with private equity increased demand for highly leveraged capital structure that created the market is high yield and mezzanine debt. That is the different one, senior debt, maybe mezzanine debt, junior debt. The increased volume of the distress of debt drew in high fund, hedge fund and credit derivative deepened the market trend outside of the control both the regulator and the lending commercial bank. Restructuring, corporate restructuring, you understand? Restructuring is the corporate management term for the act of recognizing the legal ownership, operational or other structure of a company for the purpose of making it more profitable. Now is the structure system is a very big system, but the rules in this case is some layoff. The layoff of the employer, and then is the restructuring of the management system and the production system. You understand? This is a restructuring, or the better organized for its present need. The other reason for the restructuring include a change of ownership or ownership structure, or demerge, or the response to a crisis or a major change in business such as bankruptcy, repositioning, or buyout. Restructuring may also be described as corporate restructuring, debt restructuring, and financial restructuring. Executive involved in the restructuring often the higher financial deal and the advisor to the assistants. Okay, thank you very much. We'll continue to next time is the lending term, syndicated number 1.